This course is designed to acquaint the student with the basic concepts of health administration, with a heavy emphasis on financial administration. The course starts with an overview of basic principles of accounting and financial management. It is the product of Dr. Boffa's experience in managing health plan benefits for Taft-Hartley trust funds. Taft-Hartley plans are also known as multi-employer pension and health plans, or simply Maltese. These are defined benefit plans that are collectively bargained, often by a labor union, and managed by more than one employer within the same industry. According to data from the U.S. government, there are about 1,400 of these plans in the U.S. with 10 million participants. These plans usually cover workers in the construction, service, manufacturing, mining, and trucking industries, as well as the entertainment industry. Dr. Boffa served in many capacities for Taft-Hartley Trust's self-insured health plans. Self-insured health insurance means that the trust fund is using its own money to cover the employee's claims. Most self-insured plans contract with an insurance company or independent third-party administrator, TPA, for plan administration, but the actual claims costs are covered by the trust fund's assets. Dr. Boffa, over the years, performed many functions in the administration of health benefits. For some plans, he worked with accountants and actuaries to do financial and health outcomes analysis. For some other plans, he would fulfill the role as a third-party administrator, primarily in the area of ambulatory care, such as dental, vision, and pharmacy. The course, Healthcare Management and Finance, is intended for health professionals who have no or little experience in accounting. Students are public health graduate students who intend to pursue a career in managing healthcare and public health programs. The course is the product of many years of Dr. Boffa's work as a graduate student and faculty member. He encountered many practical real-world problems outside the confines of the academic environment. His goal was always to combine the disciplines of statistics and accounting. With the management of health plan benefits, it was critical he work with both accountants and actuaries. His contribution was to judge economic efficiency in the context of health improvement. Later in this discussion, the concept of value added in accounting and healthcare will be covered. The required text covers the statistical concepts employed in performing the statistical audit, forecasting cash flow, conducting market research, and local market analysis. This course is to link healthcare issues with economic efficiency. The origin of the required Springer textbook was Dr. Boffa's consulting work with the Massachusetts Division of Healthcare Finance and Policy. He advised in the setting up of the Commonwealth's accounting and statistical procedures for ambulatory healthcare, hospital reimbursements, HMOs, and community health centers. He also conducted statistical analysis for the Massachusetts Healthcare Reform Act, that later became the model for the U.S. Affordable Care Act. The final form of the Springer book, AI-Assisted Business Analytics, came into being when he was asked by the Massachusetts Department of Revenue, Audit Division, to develop sales tax statistical audit procedures and software. The mandate was to improve the Audit Bureau's Computer-Assisted Audit Techniques, CATS program. Massachusetts Rate Setting Commission was mandated by the Commonwealth of Massachusetts to do prospective budgeting of hospitals and other healthcare facilities. This required a periodic audit of the facility by a team headed by an existing staff accountant and a recruited MPH graduate, either from Boston University or Harvard University School of Public Health. Existing experienced staff auditors were teamed with young recent graduate statisticians, which led to a growing animosity between the two numbers-oriented individuals. The commission was broken down into several bureaus such as hospital, long-term care, ambulatory care, etc., each headed by a CPA bureau director. The commissioners wanted financial audits and budget controls to also include thoughtful health outcomes assessment. It was a noble goal combining the talent of two key numbers-oriented individuals, accountants, and public health-trained statisticians. There was no consideration how to integrate the two disciplines. Both parties failed to find common ground on their different perspectives. Instead, the discussion became heated with both sides being implacable. The debate was raging when Dr. Boffa was asked by the commissioners to do a statistical course for the auditors. There was no thought to integrate both disciplines. Dr. Boffa developed a course for commission staff analysts who had a BS or AS degree in business administration and accounting. As a group, they were attentive and cooperative, but swirling in the background was an undercurrent of tension. As a third-party administrator, he did have knowledge of generally accepted accounting principles and found the common ground that developed into a good working relationship with his students. In fact, after the course, he helped them in handling large datasets. He also helped guide them on how to summarize medical procedure codes to augment their financial reporting. After the acceptance as a Microsoft partner, certification of AuditMetrics AI has the benefit of being able to download the software from the Microsoft Store online. It also allows AuditMetrics to be listed as a Microsoft partner. The mission of AuditMetrics is to make available a free small business student version. The software makes it possible to implement AI-assisted accounting and auditing immediately. For the power user, also available is AuditMetrics AI Professional v6.5, primarily larger businesses that have to manage large datasets. Professional AuditMetrics AI v6.5 has the ability to sample data involving millions of records, ideal for forensic accounting and multi-year forecasting. Both versions make it possible to speed up the learning process version by Learn by Doing. The accountant-statistician partnership, promoted by AuditMetrics' first major test, was when the Rate Setting Commission was facing a lawsuit by home healthcare agencies for changing reimbursement policies. Home healthcare agencies provide nursing care for elderly in their home. Dr. Baffa was informed that he had to attend a pre-trial discovery conference because the plaintiff team included a statistician. In the movies or television dramas, the idea of bringing previously unknown evidence into a trial is a great plot twist that makes for a big gotcha moment. In the real world, with an interest in simply finding the truth, each side knows in advance what evidence will be presented against them in a trial. The reason is the process of discovery. Realistically, only a small percentage of federal cases, criminal or civil, actually go through the entire trial process. Because trials are risky, many parties look to settle their differences during the pre-trial phase of the process. Dr. Baffa reviewed the budget allocations and found something unusual. 15% of direct labor costs was added to fixed overhead costs. That is not proper allocation, since it is double counting. But it was devised as an immediate response to solve, at that time, a nursing shortage, and it was a temporary stopgap to shore up the tremendous increase in overtime pay and to provide a sign-on bonus to attract new hires. Payrolls are subject to negotiations and not readily changed in the short term. At the pretrial conference, the statistician did present some interesting past research with the elderly, but it did not have anything to do with the issue of removing the temporary added allocation to fixed overhead. Eventually, nursing labor force market and salaries stabilized. The nursing shortage was eventually solved by the Commonwealth's increasing funding for nursing programs and an increase of immigrant nurses with green cards. The Discovery Conference became heated, with the industry side stating that reduction of funding to the agencies would cause increased deaths of the elderly. The mood was not to compromise. At the trial, the judge stated that there would be a pause as she reviews the process to date. She wanted to do a review before proceeding with the battle of statisticians. In the interim, Dr. Baffa planned to review affected agency account data and capture indirect and direct labor cost ratios to determine changes over time, compare agency values with published industry standards, merge agency account data with actual health services provided, such as patient visits and medical procedures performed, link account data with health outcome measures if available. The judge eventually dismissed the case since the Commonwealth followed the public open hearing process in announcing the temporary added allocation, and also for the subsequent suspension of that temporary allocation. After this decision, Dr. Baffa reflected upon the earlier auditor-statistician conflict when he first set up his course at the Rate Setting Commission. Only requiring auditors additional training help was a mistake because it turned out to insult the CPA Bureau directors who recruited some very talented analysts. The statisticians were young recent grads with little real-world experience. Unfortunately, some thought that only their opinions regarding analysis involving numbers is of value. Dr. Baffa had at that time worked a decade with accountants and actuaries, analyzing health plans, and should have suggested presenting basic accounting principles for the statisticians. They might not have listened, but the process would have been even-handed, since both parties should have gone through a learning curve and accommodation. This income statement document lists the 5 major components of the income statement for a for-profit business. 1. Revenue. 2. Expenses. 3. Net income equals revenue minus expenses. 4. Net taxable income equals net income minus tax deductions. 5. Net income after taxes or profit equals net taxable income minus taxes. Net income is the profit a company has earned over an accounting period, while cash flow from operating activities measures the cash coming in and out during a company's day-to-day business activities. However, income is not the same as cash flow. Income is defined by accrual accounting standards that involves taxation. For example, if a customer buys a product and pays cash, this leads to both an increase in income and cash flow. If the product is bought on credit, it is still recognized as a source of income and taxable, but there is no cash flow. The slide compares the income statement on the left with the cash flow column on the right. The income statement is used to determine net income after taxes. The column on the right is cash coming in and going out. For example, loan interest payments are tax deductible. A business monthly loan payment includes both interest and principal. The principal payments are not tax deductible like interest, but do drain cash from the business. Specifically, the cash flow statement and income statement displayed represent the company's financial position in 2 different ways. Teasing out the actual differences between the two are essential on how one can use them each to make data-driven decisions about a business. The cash flow statement shows a business's uses and sources of cash over a given time frame. The statement breaks down these sources and uses in 3 different categories: cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. It is cash flow from operating activities that the Audit Metrics AI software was developed. A cash flow statement shows the exact amount of a company's cash inflows and outflows, either monthly, quarterly, or annually. It captures the current operating results and changes on the balance sheet, such as increases or decreases in accounts receivable or accounts payable, and does not include non-cash accounting items, such as depreciation and amortization. Value added is the extra value created over and above the original value of something. For private business, it is usually the product sold to the consumer. It is the difference between a product's final selling price and the direct and indirect expenses incurred in providing that product. Another term is profitability. In public health, the challenge is how to measure value added, the value taxpayers are receiving for investment in public health and healthcare programs. Research into organizations that have achieved better health outcomes, while often lowering costs, suggests a strategic framework for value-based public health and healthcare implementation. Focusing on health outcomes aligns how patients experience their health with links to the investment incurred. This is the basis of cost-effectiveness and cost-benefit analysis of public health and healthcare programs discussed later in the course. When Massachusetts decided to get out of the rate-setting business, it converted the Rate-Setting Commission into the Division of Healthcare Finance and Policy. Its new mission was to critically examine the Massachusetts healthcare delivery system to provide objective information, develop and recommend policies, and implement strategies that benefit the people of the Commonwealth. Dr. Boffa's role was to conduct econometric analysis and assist in the financial analysis of the Massachusetts healthcare delivery system during the time of the Massachusetts healthcare reform movement. It later became the basis of the Affordable Care Act of the U.S. federal government. Shortly after completing this work, Dr. Boffa was asked by a former Mass Rate Setting Bureau director to help him implement a Massachusetts Department of Revenue mandate to get sales tax auditors up to speed in implementing the Computer-Assisted Audit Techniques, CATS program. The CATS program involves regular intervals of statistical audits. This time, Dr. Boffa's experience has taught him the approach was not to start with lectures on statistical theory. He decided to modify the software he developed for health plan analysis to specifically help auditors quickly obtain a random sample to be immediately used for an audit. That was the start of the current Audit Metrics statistical audit software. With only 3 inputs, the end product is a spreadsheet containing a random sample ready for the audit. Though many auditors resisted change, eventually it became clear the time to complete an audit was reduced by 50%. However, there were some initial problems in that the auditor's statistical knowledge lagged behind the ability to conduct the audit. For example, one auditor decided to leave off the standard statistical confidence intervals as too confusing and only presented the dollar amount of taxes not paid. When asked what was the meaning of 95% confidence interval, another explained it is 95% certain the audit result is true, not quite the proper meaning of a 95% confidence interval. The CATS program is for large corporations that can afford accounting firms with their own statisticians who started asking questions. Though Dr. Boffa did provide statistical background for the auditors, it was this blowback that made the auditors more attentive to understanding statistical theory. As of today, the specific auditing unit he trained is still using audit metrics through a next generation of auditors. Up to this point, what was discussed was the basics of 3 GAAP, or Generally Accepted Accounting Principles, documents. Also discussed is the relationship between the two numbers mathematics experts, accountants, and statisticians. The 2 variables necessary for the prediction model are month count and month total, covering 30 months. The process up to this point is to conduct a statistical audit since there was a concern about account receivables being out of control. If a problem does exist, then the first priority is to put in place strategies to assure cash flow and net income are not so divergent. Follow-up audits should be conducted to measure progress. The goal is to get net income and cash flow as close as possible before moving on to the next stage of forecasting future cash flow and conducting market research. This exhibit uses Excel to generate the regression model to predict monthly sales. Goal 3 model building pages 60 to 67 and 106 to 111 outlines the statistical methods in building prediction models. In 1801, a new heavenly body had been discovered in the asteroid belt, and no one could predict its orbit. In the end, only one man could, the 24-year-old Carl Friedrich Gauss, who invented a new method of calculating orbits. He used 2 mathematical constructs that is also the foundation of the forecasting graph displayed on the slide. One is the normal curve, sometimes called the Gaussian curve, and the other is the method of least squares. Gauss may not have been the mathematician to invent the normal curve, but he made it famous when he was the only one who could predict the orbit of the dwarf planet Ceres. With its central peak and gracefully sloping sides, the normal curve is one of the best known and important graphs in math and science. Simply put, it shows the spread of values of anything affected by the cumulative effects of randomness. And there's no shortage of applications, including stock market fluctuations, human heights, consumer preferences, IQ, drug effectiveness, and for our own purpose, projecting cash flow. The other very powerful new mathematical method that he invented was the method of least squares, or the regression prediction model using Excel to calculate. More than 2 centuries later, these methods are still essential scientific and business tools. The data conversion from audit to regression uncovered a business with a healthy growth rate. Projections for the next quarter can be compared to what actually unfolds. Any significant deviation from the trend should be carefully investigated. This basic model can be augmented with other data to analyze customer satisfaction and conduct market research. One cannot do this broad systematic analysis without also being closely connected to the personnel and operations of the business. So far, the basic model is a bivariate linear model, a dependent variable total sales with only one predictor variable, the month count. Though we have a very good fit, there is a problem with the model. Data is that of a wholesaler that supplies retail outlets. With this prediction model, the next month or quarter, it will always be higher than the previous month or quarter. That is the nature of a straight-line prediction model. But business activity is not purely linear. A complete model has to take into account seasonal fluctuations. The fourth quarter of the year and its holiday activity will always be higher than the following first quarter of the following year. The model as it exists does not allow for seasonal fluctuations. We need a new model with 2 predictor variables, monthly and quarterly predictors using multiple regression. It is a statistical technique that uses several explanatory variables to predict the outcome of a dependent variable. In essence, multiple regression is an extension of ordinary least squares, OLS, or bivariate regression that involves more than one explanatory variable. Springer Book pages 60 to 66 cover in detail how to create the quarterly input variables. 1. Detail cutoff. This is a dollar cutoff above which one reviews 100% of all transactions. A rule of thumb is that the detail stratum should represent approximately 1/3 of the total dollar volume. But Audit Metrics uses a more sophisticated statistical analytical approach. 2. The number of strata. The default value is 6 strata. A stratified random sample will yield more precise results than an unrestricted random sample of the same size. 3. Precision. The default precision or margin of error on the screen is 3%. If the audit is for a formal submission to the IRS or state revenue agency, 3% is the gold standard. If you are conducting an internal audit, but just want to get a preliminary look at the data, then choose less precise values such as 5% or 7%. This will result in a smaller sample, thus reducing cost and quickly identifying potential data problems. Precision is the primary driver of sample size.